Hello and welcome. Whether you're thinking about a home improvement project, consolidating high-interest debt, or facing an unexpected major expense, you've likely come across the term personal loan. It's a financial tool that millions of Americans use every year. But what is it really? How does it work? And what makes it different from, say, a credit card or an auto loan? Over the next 10 minutes, we're going to build the foundation for your understanding of personal loans in the United States. This is Chapter 1, your starting point. Our goal is to demystify the topic, strip away the confusing jargon, and give you the clear, basic knowledge you need before you even think about applying. Before we dive in, it is essential to state that this guide is for educational and informational purposes only. It is not intended as financial, legal, or investment advice. Financial decisions are deeply personal, and it's always recommended to consult with a qualified financial advisor who can assess your individual situation. With that important note out of the way, let's begin. So what is a personal loan at its core? Think of it as a straightforward agreement between you and a lender. The lender, which could be a bank, a credit union, or an online financial institution, agrees to give you a specific amount of money, all at once in a lump sum. In return, you agree to pay that money back over a set period of time, in regular, fixed payments. These payments are often called installments, which is why you'll sometimes hear personal loans referred to as installment loans. The most defining feature of a typical personal loan is that it is unsecured. This is a key term to understand. Unsecured means you do not have to put up any collateral to get the loan. Collateral is an asset, like your car or your house, that the lender can take if you fail to repay the loan. A mortgage, for example, is a secured loan because the house itself is the collateral. An auto loan is also secured by the vehicle you are buying. Because a personal loan is often unsecured, the lender is taking on more risk. If you don't pay, they don't have an immediate asset to claim. This higher risk for the lender is generally why interest rates on personal loans can be higher than those for mortgages or auto loans, but often lower than the rates on credit card debt. Now let's break down the three most important components of any personal loan. Think of these as the three pillars that define your loan structure. They are the principal, the interest rate or APR, and the loan term. First, the principal. This is the simplest part. The principal is the total amount of money you borrow. If you are approved for a $10,000 loan, your principal is $10,000. This is the lump sum that will be deposited into your bank account. Second, the interest rate and APR. This is the cost of borrowing the money. The interest rate is expressed as a percentage of the principal. However, a more important figure to focus on is the APR, which stands for annual percentage rate. The APR includes the interest rate plus any additional fees the lender might charge, such as an origination fee, which is a fee for processing the loan. The APR gives you a more complete and accurate picture of the total cost of the loan per year. When you compare offers from different lenders, always compare the APR, not just the interest rate. Third, we have the loan term. The term is simply the length of time you have to pay the loan back. Personal loan terms can vary widely, but they commonly range from 2 to 5 years, though some can be shorter or longer. Your loan term has a major impact on your monthly payment and the total amount of interest you'll pay. Here's the trade-off. A shorter loan term, say 3 years, will mean higher monthly payments. However, you'll pay off the loan faster and as a result, pay less in total interest over the life of the loan. On the other hand, a longer loan term, perhaps 5 years, will result in lower, more manageable monthly payments. But because you are borrowing the money for a longer period, you will end up paying significantly more in total interest. There is no universally better option. It's a balance between what you can afford monthly and how much you are willing to pay in total borrowing costs. So, how is a personal loan different from other common forms of debt? Let's quickly compare. We already touched on secured loans like mortgages and auto loans, where the key difference is collateral. Now let's consider credit cards. A credit card offers what's called revolving credit. You have a credit limit, and you can borrow, repay, and borrow again up to that limit. Your payment amount can change depending on your balance. A personal loan is not revolving. You get the money once, and you pay it back in fixed amounts until the balance is zero. You cannot reborrow the money as you pay it down. Also, personal loans typically come with a fixed interest rate, meaning your rate and payment will not change. Many credit cards have variable interest rates that can go up or down over time. Another category you might hear about are payday loans. It is crucial to understand that personal loans and payday loans are vastly different financial products. Payday loans are very short-term loans, often due on your next payday, and they are known for having extremely high APRs, sometimes reaching into the triple digits. Personal loans are structured for repayment over several years and have much more regulated, lower APRs in comparison. Finally, why do people in the US typically seek out personal loans? The reasons are as varied as the people applying for them. One of the most common uses is for debt consolidation. This is where someone takes out a single personal loan to pay off multiple other debts, like several high-interest credit cards. The goal is to simplify payments into one monthly bill and hopefully secure a lower overall interest rate. Other common reasons include financing a large purchase, like a new appliance or furniture, paying for unexpected medical bills, funding a wedding, or making home repairs and improvements that add value to a property. The flexibility of a personal loan is one of its main attractions. The money can generally be used for any legitimate purpose. To recap our first chapter, a personal loan is typically an unsecured installment loan where you receive a lump sum of money and pay it back in fixed monthly payments over a set term. The total cost is best understood by looking at the APR, and the structure of the loan is defined by the principal, the APR, and the term. It is a distinct financial tool, different from credit cards and secured loans. You now have the basic building blocks. This foundation is critical because in our next chapter, we will explore the single most important factor that lenders look at when they decide whether to approve your loan and what interest rate to offer you: your credit score. Thank you for joining us for this foundational guide. We look forward to seeing you in Chapter 2. Welcome back. In our first chapter, we built the foundation, defining what a personal loan is and breaking down its core components. Now we move from the what to the who, specifically, how lenders see you as a potential borrower. This brings us to the single most influential factor in the personal loan process: your credit score. For the next 10 minutes, we're going to demystify this powerful 3-digit number. We'll explore what it represents, why it holds so much weight with lenders, what the different score ranges mean, and the key ingredients that go into calculating it. As always, a quick reminder: this content is for educational purposes only and should not be considered financial advice. Your financial journey is unique, and consulting with a qualified professional is always a wise step before making major decisions. So let's get started. What exactly is a credit score? In the simplest terms, a credit score is a numerical summary of your credit history. Think of it as a financial report card. It's a snapshot in time that tells lenders how responsibly you've handled debt in the past. This score is generated by complex mathematical algorithms using information from your credit reports, which are maintained by the 3 major credit bureaus in the United States: Experian, Equifax, and TransUnion. While there are several scoring models, the 2 most widely known are the FICO score and the Vantage score. FICO is the model used in the vast majority of lending decisions, so we'll often refer to its framework. These scores typically range from 300 to 850. The higher the number, the more positively a lender is likely to view your credit history. Why do lenders place so much importance on this number? It's all about assessing risk. When a lender gives you a personal loan, they are taking a calculated risk that you will pay it back as agreed. Your credit score is their primary tool for quickly gauging that risk. A high score suggests to them that you have a history of paying your bills on time and managing your debts well. To a lender, this signals a lower-risk borrower, which can lead to a higher chance of loan approval and, just as importantly, a more favorable, lower annual percentage rate, APR. A lower score might suggest a history with some financial missteps, such as late payments or high balances. Lenders see this as higher risk, which could result in a loan denial or, if approved, a much higher APR to compensate for that perceived risk. Let's break down what the score ranges generally mean to lenders. While the exact numbers can vary slightly, the FICO score ranges are typically categorized as follows: exceptional, 800 to 850. This range demonstrates to lenders a long and consistent history of responsible credit management. Very good, 740 to 799. Borrowers in this range are considered very dependable and are likely to be offered competitive interest rates. Good, 670 to 739. This is a solid range. Many people fall into this category, and it generally indicates a history of responsible borrowing, making loan approval likely with standard rates. Fair, 580 to 669. In this range, lenders may see a borrower as having some potential risk. A loan might still be approved, but often at a higher interest rate. These are sometimes referred to as subprime borrowers. Poor, 300 to 579. This range signals to lenders a history of significant financial difficulties. Obtaining an unsecured personal loan can be challenging, and any offers would likely come with very high APRs. So what factors actually make up this all-important score? The FICO model is based on 5 main categories, each with a different weight. Understanding these can provide insight into how credit scores are built. First and most important, at 35% of your score is your payment history. This is straightforward. Do you pay your bills on time? A history of consistent, on-time payments will have a positive impact. Conversely, late payments, delinquencies, or bankruptcies can significantly lower your score. The second most influential factor, at 30%, is amounts owed. This is often referred to as your credit utilization ratio. It primarily looks at how much of your available revolving credit, like on credit cards, you are currently using. For instance, if you have one credit card with a $10,000 limit and a $2,000 balance, your utilization is 20%. A lower credit utilization ratio is generally viewed more favorably by scoring models. Third, at 15%, is the length of your credit history. This considers the age of your oldest credit account, your newest account, and the average age of all your accounts. A longer history of responsible credit management can have a positive influence on your score. Next, accounting for 10% of your score, is new credit. This factor looks at how many new accounts you've recently opened and how many hard inquiries are on your report. A hard inquiry is recorded when a lender pulls your credit report after you apply for new credit. Applying for a lot of credit in a short period can be a red flag for lenders. Finally, the last 10% is your credit mix. This refers to the different types of credit you have, such as credit cards, retail accounts, installment loans, like an auto loan, and mortgages. The scoring models tend to look favorably on a history of responsibly managing different kinds of credit. Knowing how your score is calculated is one thing, but how do you find out what your score is? Many banks and credit card companies now offer free credit score access to their customers as a standard feature. Additionally, there are numerous reputable websites and apps that provide free scores. It's also important to review your full credit reports for any errors or inaccuracies. Under U.S. law, you are entitled to a free copy of your credit report from each of the 3 major bureaus, once every 12 months through the official website, annualcreditreport.com. To wrap up Chapter 2, your credit score is a vital component of your financial identity. It is the primary tool lenders use to assess risk, and it directly influences your ability to get a loan and the rate you'll pay. It is calculated based on key factors like your payment history, how much debt you carry, and the length of your credit history. Now that you understand the what of personal loans and the who from a lender's perspective, we're ready to move on to the practical side of preparation. In our next chapter, we'll discuss the essential documents and information you'll need to gather before you start filling out applications. Thank you for listening, and we'll see you in Chapter 3. Hello and welcome back. In our first 2 chapters, we established what a personal loan is and explored the critical role of your credit score. With that foundation in place, it's time to move toward action. Before you even begin to browse for lenders or fill out an application, there is a crucial intermediate step: preparation. This is Chapter 3, getting your financial house in order. Over the next 10 minutes, we will walk through the essential documents you'll need to gather and the key financial metrics you should be aware of. Think of this as building your application toolkit. Being prepared not only makes the process faster and smoother, but also helps you present the clearest possible picture of your financial standing. As we proceed, please remember that this guide is for informational purposes only. It is not financial or legal advice. We are discussing common lending practices to help you understand the process, not to advise you on your personal financial decisions. So, why is this preparation phase so important? When you apply for a loan, a lender is trying to answer one fundamental question: can this applicant reliably repay the money they want to borrow? The documents you provide are the evidence they use to answer that question. Having everything ready in advance shows that you are organized and serious, and it prevents delays that could be caused by scrambling to find a specific paper or statement. Let's break this down into a practical checklist of what lenders in the U.S. typically require. First up is proof of identity. This is non-negotiable. Lenders are required by federal law, under the Patriot Act, to verify your identity to prevent fraud and other illicit activities. You will almost certainly need to provide a clear, unexpired copy of a government-issued photo ID. This could be your driver's license, a state-issued ID card, or a U.S. passport. You will also need to provide your social security number, as this is how lenders will pull your credit report. Next on the checklist is proof of address. Lenders need to confirm where you live. This is usually satisfied with a recent document that shows both your full name and your physical address. Common examples include a recent utility bill, like electricity, water, or gas, a copy of your current lease agreement or a recent mortgage statement, or even a vehicle registration card. Now for the most detailed section, proof of income and employment. This is the heart of your application. The lender needs to verify that you have a steady and sufficient source of income to make your monthly loan payments. The specific documents required can vary based on your employment situation. If you are a traditionally employed person who receives a regular paycheck, be prepared to provide recent pay stubs, typically from the last 30 to 60 days. Your most recent W-2 forms, which summarize your annual earnings from your employer. Lenders often ask for W-2s from the past 1 or 2 years to see a consistent work history. Sometimes, they may also ask for your most recent federal tax returns, especially if a portion of your income comes from bonuses or commissions. If you are self-employed, a freelancer, or an independent contractor, the documentation process is a bit more extensive because your income can be more variable. Lenders will want to see proof of stable earnings over a longer period. You should be ready to provide your federal tax returns, almost always for the last 2 years, including all schedules like the Schedule C, which reports profit or loss from a business, your 1099 MISC or 1099 NEC forms, which detail payments you've received from clients, and often several months of recent business and personal bank statements to show consistent cash flow. The goal for the lender, in either case, is to establish a verifiable, reliable monthly income figure. Beyond these core documents, lenders will also need your banking information. This includes the name of your bank, your account number, and your routing number. This serves 2 purposes. First, it's where they will deposit the loan funds if you are approved. Second, it's often used to set up automatic payments for loan repayment. Now, with your documents in order, there is one more crucial piece of information to understand: your debt-to-income ratio, or DTI. After your credit score, this is one of the most important metrics lenders use. Your DTI is a simple percentage that compares your total monthly debt payments to your gross monthly income. That is, your income before taxes are taken out. The formula is total monthly debt payments divided by gross monthly income. The result is your DTI ratio. For example, if your gross monthly income is $5,000, and your total monthly debt payments, including rent or mortgage, car payments, student loans, and minimum credit card payments, add up to $2,000, your DTI would be 40%. $2,000 divided by $5,000 is 0.40. Why does this matter so much to lenders? Because it tells them what percentage of your income is already spoken for by existing obligations. It helps them gauge whether you can comfortably afford to take on a new monthly loan payment without becoming financially overextended. While every lender has their own standards, it is common industry practice for many lenders to look for a DTI ratio below 43%, and a lower ratio is often viewed more favorably. Understanding your own DTI before you apply is an empowering step. It gives you insight into how a lender will likely view your financial situation and your capacity for new debt. To recap this chapter, preparation is key. Before applying for a personal loan, the process involves gathering your essential documents for identity, address, and income verification. It also involves understanding a key metric that lenders use, your debt-to-income ratio. By getting your financial house in order first, you streamline the process and approach it from a position of knowledge. Now that you know how to prepare, the next logical question is, where do you go to find a loan? In our next chapter, we will explore the different types of lenders available, from the traditional bank on the corner to the newest online platforms, and discuss the pros and cons of each. Thank you for joining us for Chapter 3. We'll see you in the next one. Hello, and welcome back to our guide on understanding U.S. personal loans. In our last chapter, we focused on preparation, gathering your documents and understanding your financial picture. Now, with your toolkit ready, we arrive at a critical question. Where do you actually go to get a loan? The lending landscape is more diverse than ever, and knowing your options is essential. This is Chapter 4, Where to Go, Banks, Credit Unions, and Online Lenders. Over the next 10 minutes, we'll explore the 3 main types of institutions that offer personal loans. We'll break down their common characteristics, their typical strengths, and the considerations to keep in mind for each. As we begin, please remember that the information provided here is for educational and informational purposes. It is not financial advice, nor is it an endorsement of one lender type over another. The goal is to provide you with a clear, unbiased overview, so you can better navigate the marketplace. Let's start with the most traditional option, banks. These are the institutions many of us are most familiar with. The large national names like Chase or Bank of America, as well as smaller regional and community banks. They have been the bedrock of consumer lending for decades. One of the primary characteristics of borrowing from a bank is the potential benefit of an existing relationship. If you already have a checking or savings account with a bank, they have direct insight into your financial habits. For some applicants, particularly those with strong credit and a positive banking history, this relationship can sometimes lead to a smoother process or even preferential rates. Banks also offer the advantage of in-person service. If you prefer to sit down with a loan officer, ask questions face-to-face, and handle physical paperwork, a bank provides that tangible experience. However, there are some important considerations. Banks are known for having relatively strict lending criteria. They often place a heavy emphasis on high credit scores and stable, verifiable income. For applicants who have fair credit or a less traditional employment history, securing a loan from a large bank can be more challenging. Additionally, their application process can sometimes be slower and more bureaucratic compared to more modern alternatives, potentially taking several days or even longer to get a decision and receive funds. Next, let's talk about credit unions. A credit union is a not-for-profit financial cooperative that is owned and operated by its members. Unlike a bank, which aims to generate profit for its shareholders, a credit union's primary purpose is to serve its members. To get a loan from a credit union, you first must become a member. Membership is typically based on a common bond, such as your employer, the industry you work in, your geographic location, or an association you belong to. The nonprofit structure is the key differentiator here. Because they are not driven by profit, credit unions can often pass their earnings back to members in the form of lower interest rates on loans and fewer fees. Federal credit unions, for example, have a regulatory cap on the interest rates they can charge, which can make them a very competitive option. Many people also appreciate the member-focused customer service. Credit unions may be more willing to look at your entire financial picture and work with you, even if your credit score isn't perfect. On the other hand, the membership requirement itself can be a hurdle if you don't immediately qualify. While many credit unions have broadened their membership criteria, you'll still need to find one you are eligible to join. Also, smaller credit unions may not have the same level of technological sophistication as large banks or online lenders, meaning their mobile apps and online services might be less advanced. Finally, we have the newest and fastest growing category, online lenders. These are financial technology, or fintech, companies that operate almost entirely on the internet. They don't have physical branches, which means their overhead costs are significantly lower. This category includes a wide range of companies, from well-known platforms to smaller, specialized lenders. The number one characteristic of online lenders is speed and convenience. Their application processes are designed to be completed entirely online, often in just a few minutes. Many offer the ability to get pre-qualified with a soft credit inquiry, which allows you to see potential rates and terms without impacting your credit score. If you are approved, funding can be incredibly fast, with some lenders depositing the money into your account as soon as the next business day. Online lenders also use sophisticated algorithms that may consider a wider range of data points beyond just your FICO score. This can sometimes open up access to credit for borrowers who might not meet the strict criteria of a traditional bank. However, it's important to be thorough when exploring this option. Interest rates and fees can vary dramatically from one online lender to another. Some may charge origination fees, a percentage of the loan amount deducted from your funds, while others do not. And for those who value personal interaction, the lack of a physical branch to visit for support can be a significant drawback. All communication is handled via phone, email, or online chat. To summarize, each type of lender offers a different experience. Banks may be a good fit for those with excellent credit and an existing banking relationship who value in-person service. Credit unions can be a great option for those who qualify for membership and are looking for potentially lower rates and a more personalized approach. Online lenders often appeal to those who prioritize speed, convenience, and a streamlined digital process. There is no single best place to get a personal loan. The right choice depends on your individual financial profile, your credit history, how quickly you need the funds, and your personal preference for service. Now that you know where to look, how do you compare your options effectively and without negatively affecting your credit? That brings us to our next chapter, where we will dive into the process of shopping for a loan, understanding pre-qualification, and comparing offers. Over the next 10 minutes, we will explain why you should never take the first offer you see, how to compare multiple loan options without hurting your credit score, and what specific details to look for when you have those offers in hand. As we continue, it's important to remember that this guide is for informational purposes only. The principles we're discussing are standard practices in the U.S. lending industry, designed to help you understand the process, not to provide personal financial advice. Let's start with a fundamental concept. A loan is a product, and you are the customer. Just as you would compare prices and features when buying a car or a major appliance, it is crucial to shop around for a personal loan. The rates, fees, and terms offered by lenders can vary significantly, even for the same applicant. The first offer you receive is simply a starting point. It is not necessarily the most competitive one available. Even a small difference in the annual percentage rate, or APR, can translate into hundreds or even thousands of dollars in interest paid over the life of the loan. For example, on a hypothetical $10,000 loan with a 5-year repayment term, the difference between a 10% APR and a 13% APR could amount to a difference of nearly $900 in total interest. This illustrates why comparison shopping is not just a suggestion. It's an essential part of making an informed financial decision. But this raises a critical question. Doesn't applying for a bunch of loans hurt your credit score? This is a common and valid concern, and it leads us to the most important tool for smart loan shopping: pre-qualification. To understand pre-qualification, we first need to know the difference between a soft and a hard credit inquiry. A soft credit inquiry, sometimes called a soft pull, is a preliminary review of your credit file. It happens when you check your own credit, or when a company checks it to see if you are eligible for a pre-approved offer. Most importantly, a soft inquiry is only visible to you on your credit report and has zero impact on your credit score. A hard credit inquiry, or a hard pull, is different. This occurs when you formally apply for credit, like a loan or a credit card. When you do this, you give the lender explicit permission to perform a deep dive into your credit history. A hard inquiry is recorded on your credit report and can cause a temporary, small dip in your credit score, typically by a few points. This is where pre-qualification comes in. Most online lenders and many banks and credit unions now offer a pre-qualification process. This is where you provide some basic financial information, and the lender performs a soft credit inquiry to give you an estimate of the loan amount, rate, and terms you might be approved for. It is not a guaranteed offer of credit, but it is a genuine, personalized preview. The strategy, therefore, is to get pre-qualified with multiple lenders. You can get 3, 4, or even more pre-qualification estimates, allowing you to see real numbers and compare actual offers, all without a single hard inquiry impacting your credit score. Only after you have compared these offers and chosen the best one for your situation do you proceed with a formal application, which will then trigger a single hard inquiry. So, once you have these pre-qualification offers, what exactly should you be comparing? Here are the key factors to look at side by side. First and foremost, compare the APR. As we've mentioned before, the annual percentage rate is the most accurate measure of the loan's total cost, because it includes both the interest rate and most of the associated fees. Always use the APR as your primary comparison point. Second, look at the monthly payment and the loan term. An offer might have an attractive, low monthly payment, but check if that's because the loan term is very long, like 60 or 72 months. A longer term means you'll pay more in total interest. You need to consider the balance between a payment that fits your monthly budget and the total long-term cost of the loan. Third, pay close attention to fees. The most common one is an origination fee. This is a one-time, upfront fee that some lenders charge for processing the loan. It's typically calculated as a percentage of the loan amount, from 1% up to 8% or more. This fee is usually deducted from the loan funds before you receive them. For example, if you are approved for a $10,000 loan with a 5% origination fee, the lender will deduct $500, and you will receive $9,500 in your bank account, but you will still be responsible for repaying the full $10,000. Not all lenders charge this fee, making it a critical point of comparison. Also, check for any prepayment penalties. While less common today, some lenders may charge a fee if you pay off your loan ahead of schedule. Ensure the offers you are considering allow for early repayment without penalty. In summary, the smart shopping process looks like this. Identify a handful of potential lenders from each category: banks, credit unions, and online lenders.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Use their online tools to get pre-qualified, leveraging soft credit inquiries. Create a simple chart or list to compare the offers, focusing on APR, loan term, monthly payment, and fees. Once you've identified the most favorable offer, you then proceed to that lender's site to complete the formal application. By following this process, you transform from a passive loan taker into an empowered loan shopper. Now that you know how to shop for and select the best offer, what happens next? In our next chapter, we will cover the final steps: submitting the formal application, the underwriting and verification process, and what to expect after you are approved and the loan is funded. Thank you for joining us. We will see you in Chapter 6. Hello and welcome back. In our previous chapter, we navigated the crucial process of shopping around and using pre-qualification to compare loan offers without impacting your credit score. You've weighed your options, compared the APRs and terms, and have selected the lender that seems to be the best fit for your situation. Now you're ready to move forward. This is Chapter 6, the final steps: application, underwriting, and funding. Over the next 10 minutes, we will walk you through the final stage of the loan acquisition process. We'll cover what to expect when you submit your formal application, demystify the lender's verification process known as underwriting, and explain what happens after you're approved and awaiting your funds. As always, please remember this information is for educational purposes only. It is intended to clarify the standard procedures in the lending industry and is not a substitute for professional financial advice. The first step in this final phase is submitting the formal application. This is different from the pre-qualification you've done so far. At this stage, you are officially asking the lender to grant you a loan. This is the point where you give them permission to perform a hard credit inquiry, which, as we discussed, will be recorded on your credit report. The formal application will be more detailed than the initial pre-qualification form. You will need to confirm the information you provided earlier and likely add more specific details. This is where the preparation you did in Chapter 3 becomes invaluable. You will be asked to upload or provide the specific documents we discussed, such as your pay stubs, W-2s, tax returns, and proof of identity. A word on accuracy. It is absolutely critical that the information you enter on the application is truthful and perfectly matches your supporting documents. Even small discrepancies, like a typo in your stated income or a wrong address, can cause significant delays in the review process or, in some cases, lead to a denial. Take your time and double-check every entry before you hit submit. Once your application is submitted, it moves into a stage called underwriting. This might sound like a complex industry term, but the concept is simple. Underwriting is the lender's verification and risk assessment process. It's where a human underwriter, a sophisticated computer algorithm, or a combination of both, meticulously reviews your entire financial profile to make a final lending decision. During underwriting, several things happen behind the scenes. First, the underwriter will conduct a detailed analysis of your credit report obtained from that hard pull. They're looking at your credit history, payment patterns, and existing debts. Second, they will perform income and employment verification. They will scrutinize the pay stubs, W-2s, or tax returns you submitted to confirm your income is stable and sufficient. In some cases, and only with your permission, they may contact your employer to verify that you are currently employed. Third, they will verify your identity and other personal information, ensuring everything is legitimate. Finally, they will calculate your debt-to-income ratio and use their own internal criteria to assess the overall risk of the loan. It is not uncommon for a lender to contact you during the underwriting process. They may have a simple question or require an additional document, such as an extra bank statement or a clearer copy of your ID. Responding to these requests promptly can significantly speed up the process. If the underwriting process is successful, you will receive a final approval. This will be accompanied by an official loan agreement. This is the legally binding contract between you and the lender, and it is imperative that you read it thoroughly before signing. Here are the key things to check in the final loan agreement to ensure they align with your expectations. Confirm the final APR. Does it match the rate you were quoted in your pre-qualified offer? Check the total loan amount and the actual disbursed amount you will receive after any origination fee is deducted. Verify the exact monthly payment amount and, crucially, the due date of your first payment. Confirm the loan term, which is the total number of payments you will be making. And finally, carefully review the sections detailing any fees, such as late payment fees or insufficient funds fees. You will also receive a Truth in Lending Act (TILA) disclosure statement. This is a federally required document that provides a standardized summary of your loan's key terms and costs. making it easy to review. Once you have reviewed the agreement and are ready to proceed, you will sign it. In today's digital world, this is almost always done electronically with a secure e-signature. The very last step is funding. After you've signed the agreement, the lender will release the money. The most common method is a direct deposit into the bank account you provided. The timing for this can vary. Many online lenders are very fast, with funds sometimes arriving as quickly as the next business day. For other lenders, it might take 2 to 5 business days. The loan agreement will typically provide an estimated funding timeframe. For those taking out a loan specifically for debt consolidation, some lenders offer the option to send the funds directly to your creditors, paying off your credit card balances for you. This can be a convenient feature that ensures the money is used for its intended purpose. To recap, this final phase moves from a formal application and a hard credit pull, through the lender's underwriting and verification process, to a careful review of the final loan agreement, and culminates in the funding of your loan. You've now journeyed from understanding what a loan is to actually having the funds in your account. But the journey isn't over. In our next chapter, we will discuss the life of the loan, how to manage it responsibly to build a positive financial future. Thank you for joining us for Chapter 6. We'll see you in the next one. Hello and welcome back. In our last chapter, we successfully navigated the final steps of the loan process, from application to funding. The money is in your account, and the agreement is signed. This marks the beginning of a new and equally important phase. The life of the loan. This is Chapter 7, Managing Your Loan Responsibly, Payments, Pitfalls, and Payoffs. For the next 10 minutes, we'll shift our focus from getting a loan to living with a loan. We'll discuss the best practices for managing your payments, how to understand your loan statement, what to do if you encounter financial difficulties, and the benefits of paying your loan off. As we move forward, please remember this guide is for informational purposes only. The principles discussed are meant to educate you on the mechanics of loan management and are not a form of personal financial advice. The foundation of responsible loan management is simple but non-negotiable: making your payments on time, every time. A consistent history of on-time payments is the single most important factor in building a positive credit history. To facilitate this, most lenders offer the option of setting up automatic payments, often referred to as autopay. This is an arrangement where you authorize the lender to automatically withdraw your monthly payment from your bank account on the due date. The primary benefit is convenience and peace of mind. It helps ensure you never accidentally miss a payment. As an added incentive, it is a common industry practice for many lenders to offer a small interest rate discount, often 0.25% or 0.25%, for enrolling in autopay. Over the life of a loan, this small discount can add up. Of course, making manual payments online by phone or by mail each month is always an option for those who prefer more hands-on control. Each month, you'll receive a loan statement from your lender, either electronically or in the mail. It's a good practice to review this statement. On it, you will see a breakdown of how your payment was applied. You'll typically find the total payment amount, and next to it, how much of that payment went toward interest and how much went toward the principal. The principal is the actual amount you borrowed. You'll notice that in the early stages of a loan, a larger portion of your payment goes toward interest. As time goes on and your balance decreases, more and more of each payment gets applied to the principal. This process is called amortization. Understanding this helps you see how you are systematically paying down your debt over time. Now let's talk about potential challenges. Life is unpredictable, and financial situations can change. It's important to be aware of common pitfalls. The most obvious is a late payment. Most loan agreements include a grace period, often around 10 to 15 days after the due date. If a payment is made after this grace period, the lender will typically charge a late fee. More significantly, if a payment becomes more than 30 days late, lenders will report it to the credit bureaus, which can have a direct negative impact on your credit score. But what if you face a serious financial hardship, like a sudden job loss or a medical emergency, and you anticipate you won't be able to make your next payment? In these situations, proactive communication is key. It is almost always better to contact your lender before you miss a payment. Lenders have hardship programs and may be able to offer temporary solutions. These are not guaranteed, but common options can include forbearance, which allows you to temporarily pause or reduce your payments for a short period, or a modified payment plan, which might temporarily lower your payment amount. It's important to understand that during a forbearance period, interest often continues to accrue, meaning your loan balance will increase. However, engaging with your lender about these options can often prevent the negative consequences of a delinquency or default on your credit report. On the other side of the spectrum, what if your financial situation improves and you're able to pay more than your required monthly payment? This brings us to the topic of paying off your loan early. For most personal loans in the US, there are no prepayment penalties, meaning you are free to pay off the loan ahead of schedule without being charged a fee. The primary benefit of doing this is significant savings on interest. Since interest is calculated on your outstanding balance, every extra dollar you pay toward the principal reduces the amount of future interest you'll owe. There are a couple of common ways to do this. You can make larger, lump sum payments whenever you have extra funds, or you can add a little extra to your regular monthly payment. If you choose to pay extra each month, it's a good practice to notify your lender that you want the additional amount to be applied directly to the principal balance. Successfully managing and paying off a personal loan is a major financial accomplishment. A consistent record of on-time payments on an installment loan demonstrates to the credit bureaus that you are a reliable borrower, which can have a positive long-term effect on your credit score. Closing the account may cause a minor, temporary dip in your score because it can affect your credit mix and the age of your accounts, but this is usually outweighed by the positive payment history you've built. To recap, responsible loan management is about consistency, communication, and awareness. Set up a reliable payment system, understand your statements, communicate with your lender if you face hardship, and know your options for early repayment. Now that you understand how to manage a loan, what if your circumstances change dramatically for the better? What if your credit score improves and you see much lower interest rates being offered? This leads us to our next topic. In Chapter 8, we will explore the world of personal loan refinancing and look at other financial alternatives. Thank you for joining us. We'll see you in the next chapter. Hello and welcome back. In our last chapter, we focused on the crucial phase of responsibly managing your personal loan. But what happens when your financial life changes for the better after you've already taken out the loan? Perhaps your income has increased, or your credit score has seen a significant jump. This opens up new possibilities. This is Chapter 8, Refinancing a Personal Loan and Exploring Alternatives. Over the next 10 minutes, we'll define what it means to refinance a loan, explore the common scenarios where someone might consider it, and briefly touch on other types of financial tools that exist for similar purposes. As always, this chapter is for educational purposes only. We are exploring financial concepts and strategies, not providing recommendations or advice. It is always best to consult with a qualified financial professional to discuss your personal situation. Let's begin with the main topic. What is personal loan refinancing? In simple terms, refinancing is the process of taking out a new loan to pay off an existing one. You're essentially replacing your old debt with a new, and hopefully better, one. The primary goal for most people who refinance is to improve their financial situation in one of three ways. First, and most commonly, is to secure a lower interest rate. If your credit score has improved significantly since you first took out your loan, you may qualify for a much lower APR. A lower rate means you'll pay less in total interest over the remaining life of the debt, which can lead to considerable savings. Second is to lower the monthly payment. This can be achieved through a lower interest rate, or by extending the repayment term. For example, if you have 2 years left on your current loan, you might refinance into a new 3-year or 5-year loan. While this would likely mean paying more interest in the long run, it can provide immediate relief to a strained monthly budget. And third, some people refinance to shorten the loan term. If your income has increased, you might be able to afford a higher monthly payment. By refinancing into a loan with a shorter term, say from 4 years down to 2, you'll pay off the debt much faster and save a substantial amount on interest. So, what are some common situations that lead people to consider refinancing? The most frequent scenario is a significant improvement in their credit score. As we learned in Chapter 2, your credit score is the key to the rates you're offered. If you've been managing your loan and all other debts responsibly for a year or two, your score may have climbed into a higher tier, unlocking access to more competitive loan offers. Another situation is a general drop in market interest rates. The rates lenders offer are influenced by the broader economy. If overall rates have fallen since you took out your loan, it may be possible to refinance at a better rate, even if your personal credit profile hasn't changed much. Finally, an improvement in your overall financial health, such as a pay raise or paying off other debts, can also be a trigger. A higher income and a lower debt-to-income ratio make you a less risky borrower in the eyes of lenders, which can lead to better loan terms. The process for refinancing is very similar to the one for getting your original loan. It involves shopping around with different lenders, getting pre-qualified using soft credit inquiries to see potential rates, and then submitting a formal application to the lender you choose, which will result in a hard credit inquiry. If approved, the new lender will typically pay off your old loan directly. From that point on, you simply make your payments to the new lender under the new terms. One key calculation to consider is the break-even point, ensuring that the savings from the new, lower interest rate will be greater than any costs associated with the new loan, such as an origination fee. Now, while personal loans are a versatile tool, it's useful to be aware of other financial products that exist. This is for context, as these are very different tools with their own unique structures and risks. One common alternative for homeowners is a home equity loan or a home equity line of credit, HELOC. These are loans that are secured by the equity in your home. That's the difference between what your home is worth and what you still owe on your mortgage. Because these loans are secured by collateral, your house, they often come with lower interest rates than unsecured personal loans. However, they carry a very significant risk. If you fail to repay the loan, the lender can foreclose on your home. Another tool often used for consolidating debt is a 0% APR balance transfer credit card. This is a promotional offer where a credit card allows you to transfer a balance from another high-interest card or loan and pay zero interest for a limited period, often 12 to 21 months. This can be an effective way to pay down debt without accruing interest. The main consideration here is that the 0% rate is temporary. If the balance is not paid in full by the time the promotional period ends, a high standard interest rate, which is often much higher than a personal loan rate, will be applied to the remaining balance. To summarize this chapter, refinancing a personal loan is an option that may become available if your financial profile improves, potentially allowing you to secure a better interest rate or a more suitable payment plan. The process mirrors that of obtaining an original loan. It's also helpful to be aware of other financial tools, like home equity products and balance transfer cards, while understanding their distinctly different structures and associated risks. Having explored how to manage and even change your loan, there's one more area we should touch upon: the intersection of personal loans and your taxes. In our next chapter, we will discuss this topic to round out your understanding. Thank you for joining us for Chapter 8. We look forward to seeing you in the next one. Hello and welcome back. In our previous chapter, we explored the concept of refinancing a personal loan and looked at other financial alternatives. As we continue to build a complete picture of personal loans, it's important to touch on a topic that often raises questions: taxes. This is Chapter 9, Personal Loans and Your Taxes, a general overview. Over the next 10 minutes, we will address some of the most common questions about how personal loans interact with U.S. federal income taxes. Before we go any further, it is absolutely essential to start with a disclaimer. The information in this chapter is for general educational purposes only and is not tax advice. Tax laws are incredibly complex. They can change, and they apply differently to every individual's unique situation. You should always consult with a qualified tax professional, such as a certified public accountant or a licensed tax advisor, for guidance specific to your circumstances. With that understood, let's address the first and most common question. Is the money you receive from a personal loan considered taxable income? The answer in almost all cases is no. According to the Internal Revenue Service, or IRS, the proceeds from a loan are not considered income. The reason is simple. When you receive loan funds, you also take on a legal obligation to pay that money back. It is a debt, not an earning. Because it doesn't increase your net worth, it isn't treated as income on your tax return. So if you take out a $20,000 personal loan, you do not need to report that $20,000 as income to the IRS. This leads to the next logical question. If the loan itself isn't income, is the interest you pay on that loan tax deductible? For the vast majority of personal loans used for typical personal expenses, the answer is also no. The IRS categorizes the interest paid on loans for personal use as personal interest, which is not deductible. This includes loans taken out for reasons such as consolidating credit card debt, paying for a wedding or a vacation, buying furniture or appliances, or covering personal medical bills. So if you pay, for example, $1,000 in interest on your personal loan over the course of a year, you generally cannot deduct that amount from your taxable income. However, as with many tax rules, there are a few very specific and narrow exceptions where interest on a personal loan might be deductible. These situations require meticulous record-keeping and are subject to strict IRS rules. The first exception is for documented business expenses. If you can prove that you used 100% of the personal loan funds exclusively for qualifying business purposes, For example, to buy inventory for your small business or purchase equipment. The interest you pay on that loan may be deductible as a business expense on a Schedule C form. The key here is that the funds cannot be commingled. They must be clearly and solely used for the business. A second, more complex exception relates to using the loan for taxable investment purposes. If you use the loan proceeds to buy investments like stocks or bonds that generate taxable income, you may be able to deduct the interest you pay on the loan up to the amount of your net investment income for the year. This is known as the investment interest deduction, and the rules surrounding it are very complicated. A third exception could apply to qualified higher education expenses. While there are dedicated student loans for this purpose, if a personal loan is taken out and the funds are used exclusively to pay for qualified tuition and fees, the interest paid might be deductible under the same rules as the student loan interest deduction, subject to income limitations and other requirements. Again, these are rare and highly specific circumstances. Claiming these deductions requires a clear paper trail and a thorough understanding of tax law, reinforcing the need to work with a tax professional. Finally, there is one more important tax-related concept to understand. What happens if a debt is canceled or forgiven? If you are unable to pay back your loan, and the lender eventually forgives or cancels all or part of the debt, this can have a significant tax consequence. In general, if a lender cancels a debt of $600 or more, the IRS considers that canceled amount to be taxable income for you. The lender will typically send both you and the IRS a tax form called a 1099-C for cancellation of debt. You are then usually required to report that amount as income on your tax return. There are some exceptions to this rule, for instance, in cases of bankruptcy or insolvency, but these are legal and financial determinations that absolutely require professional guidance. The key takeaway is that forgiven debt is generally not free money. It's often treated as income by the IRS. Let's quickly summarize the key points of this chapter. First, the money you receive from a personal loan is generally not considered taxable income. Second, the interest you pay on a personal loan used for personal expenses is typically not tax deductible. Third, there are a few narrow, specific exceptions for business, investment, or educational use, which require strict documentation and professional tax advice. And fourth, if a lender forgives your debt, the canceled amount is often treated as taxable income. This information provides a basic framework, but when it comes to your own tax return, there is no substitute for the advice of a qualified professional. Now that we've covered the entire life cycle of a loan, from application to payoff and even its tax implications, it's time to put it all into a broader context. In our next chapter, we'll discuss how personal loans can fit into a larger financial picture and a strategy for building a healthier financial future. Thank you for joining us for Chapter 9. We'll see you in the next one. Hello and welcome back. Over the last 9 chapters, we have taken a deep dive into the world of U.S. personal loans. We've journeyed from the most basic question of what is a loan, all the way through the application process, responsible management, and even the tax implications. You now have a comprehensive understanding of the mechanics of this financial tool. This is Chapter 10, Beyond the Loan, Building a Healthy Financial Future. In this chapter, we're going to zoom out and look at the bigger picture. A personal loan doesn't exist in a vacuum. It is one part of your larger financial life. So, how does this tool fit into a long-term strategy for financial well-being? As we discuss these broader concepts, please remember this information is for educational purposes only. These are general principles of financial literacy, not personalized financial advice. Your path is unique, and consulting with a qualified financial planner is always a valuable step. The most important concept to grasp is that a personal loan is a tool, not a cure-all solution. Like any tool, its effectiveness depends entirely on how it's used. A loan can be a powerful tool to solve a specific problem, like consolidating high-interest debt into a single, manageable payment, or financing a critical, one-time expense like a major home repair. However, a loan does not, by itself, solve underlying financial habits. For instance, if someone uses a debt consolidation loan to pay off several credit cards, that can be a very positive step. But if they then continue to overspend on those same credit cards, the loan has only treated a symptom, not the root cause. The most effective use of a personal loan happens when it's combined with a broader plan for managing one's finances going forward. When managed correctly, the positive impact of a personal loan can extend far beyond its initial purpose. As we've discussed, responsibly repaying an installment loan is a powerful way to build a positive credit history. Every on-time payment is reported to the credit bureaus, demonstrating your reliability as a borrower. Over the course of several years, successfully paying off a personal loan adds a strong, positive account to your credit file. This can be instrumental in achieving future financial milestones, as it may help you qualify for more favorable rates on larger loans you might need down the road, such as a mortgage or an auto loan. So once the loan is in place and you're managing it, what other pillars of financial health can you focus on? Let's talk about a few foundational principles. The first is building an emergency fund. An emergency fund is simply a savings account that is set aside for unexpected, essential expenses, things like a sudden car repair, an urgent medical bill, or a period of unemployment. The primary purpose of this fund is to create a financial cushion so that when life's emergencies happen, you don't have to rely on debt to cover them. A common guideline often suggested by financial experts is to aim for 3 to 6 months' worth of essential living expenses in this fund. Having this safety net in place provides immense peace of mind and is a cornerstone of financial stability. The second pillar is developing a budget. The word budget can sound restrictive, but it's simply a plan for your money. It's about consciously directing where your income goes, rather than wondering where it went at the end of the month. There are many different budgeting methods, from detailed spreadsheets to simple apps or the popular 50/30/20 framework, where 50% of income goes to needs, 30% to wants, and 20% to savings and debt repayment. The specific method isn't as important as the act of creating a plan that works for you. The third pillar is to continue monitoring your credit. Your financial life is dynamic, and your credit profile is a living document. It's a good practice to regularly check your credit score, which many banks and credit card companies now provide for free. It's also wise to review your full credit report from each of the 3 major bureaus at least once a year, which you can do for free at the federally authorized website, annualcreditreport.com. This allows you to track your progress, celebrate your successes, and catch any potential errors before they become major problems. By embracing these principles, you begin to shift your focus from simply managing a loan to actively building a strong financial future. The loan becomes a single chapter in a much larger story of financial empowerment, where you are in control and directing your resources toward long-term goals, whether that's saving for a down payment, investing for retirement, or achieving another personal dream. To summarize this chapter, a personal loan is best viewed as a strategic tool within a larger financial plan. Its responsible use can positively impact your credit and help you achieve specific objectives. But for long-term financial health, this tool should be complemented by foundational pillars like building an emergency fund, creating a workable budget, and continuously monitoring your credit. Having this broader context is key. To help reinforce all the lessons we've learned, our next chapter will address some of the most common myths and misunderstandings about personal loans. Thank you for joining us for Chapter 10. We'll see you in the next one. Hello and welcome back. In our last chapter, we took a high-level view, discussing how a personal loan can be a tool within a larger strategy for building a healthy financial future. Now we're going to zoom back in and get practical. Throughout this series, we've covered a lot of ground, and a great way to reinforce these lessons is to address the common misunderstandings and pitfalls that can trip people up. This is Chapter 11, Common Personal Loan Myths and Mistakes to Avoid. Over the next 10 minutes, we will debunk some of the most prevalent myths about personal loans and highlight some frequent but avoidable mistakes. Our goal is to equip you with the clarity to navigate the process like a savvy, informed consumer. As always, this information is for educational purposes. We are discussing general facts and common scenarios, not providing personalized financial advice. Let's start by tackling some common myths. Myth number 1. Any personal loan is automatically a better deal than credit card debt. This is one of the most common reasons people seek out personal loans, and while it is often true, it is not a universal guarantee. The reality is that the terms of a personal loan are highly dependent on your credit score and financial profile. While a borrower with good to excellent credit will likely be offered a personal loan with a much lower APR than their credit cards, a borrower with a fair or poor credit score might receive a loan offer with an APR of 25% or higher. This could be more expensive than some of their existing credit card debt. The key takeaway is to never assume. Always compare the specific APR of the loan offered directly against the APRs of the debts you intend to pay off. Myth number 2. Shopping for a loan and getting pre-qualified will hurt my credit score. This is a major misconception that can prevent people from finding the best deal. The reality, as we covered in Chapter 5, lies in understanding the difference between a soft and a hard credit inquiry.
Disclaimer. The information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
When you get pre-qualified for a loan, lenders perform a soft inquiry. This has zero impact on your credit score. It allows you to see real, estimated offers from multiple lenders safely. The hard inquiry, which can cause a small, temporary dip in your score, only occurs when you select one lender and submit your formal, final application. The smart strategy is to use the power of soft inquiries to shop around extensively. Myth number 3. The interest rate is the only number that really matters. The interest rate is certainly important, but it's not the whole story. The reality is that you need to focus on the APR, or annual percentage rate. The APR includes the interest rate plus most of the loan's fees, giving you a truer picture of the total cost. A loan with a lower interest rate, but a high origination fee might actually be more expensive than a loan with a slightly higher interest rate and no origination fee. You also have to consider the loan term. A low monthly payment might seem appealing, but if it's attached to a very long term, you could pay much more in total interest. Myth number 4. You need to have a perfect credit score to get a personal loan. This is simply not true. While a perfect credit score will certainly unlock the best possible rates and terms, the market is vast. The reality is that there are many reputable online lenders and credit unions that specialize in working with applicants across the credit spectrum, including those with fair credit scores, typically in the 600s. The loan products for these borrowers are designed to accommodate a higher perceived risk, which means the APR will be higher, but access to credit is often still possible. Now let's shift from myths to common mistakes to avoid. Mistake number 1. Not shopping around. This is the single biggest mistake a borrower can make. It's easy to see an offer, perhaps from your primary bank or one you saw advertised, and simply accept it. But as we've discussed, lenders can offer vastly different terms to the exact same applicant. Failing to get pre-qualified with at least 3 to 5 different lenders means you could be leaving a significant amount of money on the table in the form of higher interest payments. Mistake number 2. Borrowing more than you absolutely need. When you get approved for a loan, the lender will often approve you for a maximum amount. It can be tempting to take the full amount, thinking the extra cash could be useful. However, it's crucial to remember that every dollar you borrow is a dollar you must pay back with interest. Before accepting a loan, have a precise and calculated need. Borrowing only what you need for your specific purpose ensures that you are not taking on unnecessary debt and paying extra interest for no reason. Mistake number 3. Not reading the final loan agreement. The pre-qualified offer gives you a great preview, but the final loan agreement is the legally binding contract. A common mistake is to be so excited about the approval that you just quickly sign the document without reading it. It is essential to read the fine print. Verify that the APR, loan amount, monthly payment, and origination fee all match what you were expecting. Check the details on late fees and confirm that there are no prepayment penalties. This final review is your last chance to ensure you understand 100% of the terms you are agreeing to. By understanding these myths and being aware of these common mistakes, you can approach the personal loan process with confidence and clarity, making decisions that are well-informed and aligned with your financial goals. We're nearing the end of our series. To help you remember all the key concepts we've discussed, our next chapter will be a helpful reference guide, an A to Z glossary of all the important personal loan terms. Thank you for joining us for Chapter 11. We'll see you in the next one. Hello and welcome back. Over the course of this series, we've journeyed through the entire personal loan process, from the first thought of applying to the final payment. Along the way, we've used a lot of specific financial terms. Understanding this language is key to feeling confident and in control of your financial decisions. This is Chapter 12, the A to Z glossary of personal loan terms. Think of the next 10 minutes as your personal reference guide. We're going to define the most important terms we've discussed in a clear, simple, and alphabetical format. Our goal is to ensure you are fluent in the language of lending. As this chapter is purely for educational reference, we remind you that it is not financial advice. Let's begin. A is for amortization. Amortization is the process of paying off a loan with fixed, regular payments over a set period. Each payment is divided into 2 parts. One part covers the interest, and the other part reduces your principal balance. In the beginning of the loan, a larger portion of your payment goes to interest. As you pay the loan down, more of each payment goes toward the principal. A is also for annual percentage rate, or APR. This is perhaps the most important term for comparing loans. The APR is the total cost of borrowing money for 1 year, including the interest rate plus most lender fees, like an origination fee. It is expressed as a percentage. Always compare APRs when shopping for a loan. C is for collateral. Collateral is an asset, like a car or a house, that a borrower pledges to a lender to secure a loan. If the borrower fails to repay, the lender can take the collateral. Most personal loans are unsecured, meaning they do not require collateral. C is also for credit score. A credit score is a 3-digit number, typically ranging from 300 to 850, that represents your creditworthiness. Lenders use it to determine your likelihood of repaying a loan, which heavily influences loan approval and the APR you are offered. D is for debt-to-income ratio, or DTI. Your DTI is the percentage of your gross monthly income that goes toward paying your monthly debt obligations. Lenders use this key metric to assess your ability to manage a new loan payment. D is also for default. A loan is in default when the borrower fails to make payments as required by the loan agreement. Defaulting on a loan has severe negative consequences for your credit score and financial standing. H is for hard inquiry. Also called a hard pull, this is an official credit check that occurs when you formally apply for a loan. A hard inquiry is visible to other lenders and can cause a small, temporary dip in your credit score. I is for installment loan. This is a type of loan where you borrow a lump sum of money and pay it back in equal, fixed payments, or installments, over a set period. Personal loans are a classic example of an installment loan. I is also for interest rate. This is the percentage that a lender charges for the use of their money, calculated based on the principal loan amount. It does not include fees, which is why the APR is a more complete measure of a loan's cost. O is for origination fee. This is an upfront, one-time fee that some lenders charge to cover the cost of processing and underwriting a new loan. It is typically a percentage of the loan amount, and is often deducted from the funds you receive. P is for pre-qualification. This is a preliminary step where a lender gives you an estimate of the loan amount and terms you might qualify for. It is based on a soft credit inquiry and does not affect your credit score, making it the perfect tool for shopping around. P is also for principal. The principal is the original amount of money you borrow from the lender, before any interest is charged or fees are added. Your monthly payments work to pay down this principal balance over time. R is for refinancing. Refinancing is the process of taking out a new loan to pay off an existing loan. People often do this to secure a lower interest rate, change their monthly payment, or adjust the loan term. S is for soft inquiry. Also known as a soft pull, this is a type of credit check that does not impact your credit score. It is used for pre-qualification purposes, and when you check your own credit. T is for term. The loan term is simply the length of time you have to repay the loan. Personal loan terms are often expressed in months, such as 36 months for a 3-year loan or 60 months for a 5-year loan. U is for unsecured loan. An unsecured loan is a loan that is not backed by any collateral. Lenders approve these loans based solely on the borrower's creditworthiness. The vast majority of personal loans are unsecured. This glossary covers the essential vocabulary you need. Understanding these terms empowers you to read loan documents with clarity and discuss your options with confidence. Feel free to return to this chapter anytime you need a quick refresher. Now that we are all speaking the same financial language, our next chapter will explore how the personal loan experience can differ based on your starting point, by looking at the process for borrowers with different credit profiles. Thank you for joining us for Chapter 12. We'll see you in the next one. Hello and welcome back. In our last chapter, we built a comprehensive glossary, ensuring we all share the same financial vocabulary. Now, we're going to apply that vocabulary to see how the personal loan journey can look very different for people starting from different places. The single biggest factor influencing this journey is, of course, the credit score. This is Chapter 13. Personal loans for different credit profiles. Good versus fair credit. Over the next 10 minutes, we will explore 2 generalized scenarios to illustrate how the process, from the options available to the terms you're offered, can change based on your credit standing. We'll look at a hypothetical borrower with good credit and one with fair credit. It is crucial to state that these are illustrative examples for educational purposes only. Lenders have a wide variety of criteria, and individual results will vary. This is not financial advice, but an exploration of how the lending market typically operates. For our discussion, we'll define good credit as a FICO score roughly in the 670 to 739 range, and fair credit as a score in the 580 to 669 range. Let's begin with the experience of a borrower with good credit. For this individual, the lending landscape is quite broad. They are generally seen as a reliable, lower-risk applicant. As a result, they will likely have access to a wide array of lender types, including major national banks, most credit unions, and the majority of reputable online lenders. They are a desirable customer. During the shopping and pre-qualification phase, a borrower with good credit is in a strong position. They will likely receive multiple, competitive pre-qualification offers. Their task is less about simply finding an approval, and more about sifting through favorable offers to find the best possible deal. They can focus on comparing the finer points. Which lender offers the absolute lowest APR? Which one has no origination fee? Which one provides the most flexible repayment term? In terms of expected loan offers, this borrower can anticipate receiving APRs that are near or sometimes even better than the national average. They are more likely to be approved for larger loan amounts, should they need them. Lenders may also be more willing to offer them a wider range of repayment terms, from short 2-year plans to longer 5- or 7-year plans. Any origination fees they encounter are likely to be on the lower end of the lender's spectrum. The underwriting process for a borrower with good credit is also typically more streamlined, as their credit history already tells a story of reliability. Now let's shift our focus to the experience of a borrower with fair credit. This individual is often seen by lenders as having some past financial missteps, making them a higher-risk applicant. However, the market for these borrowers is robust. While they might find it more challenging to get approved by a large traditional bank, a great number of online lenders and many credit unions specialize in working with this credit tier. Their options are plentiful, but they are often found in a different segment of the lending marketplace. During the shopping and pre-qualification phase, the objective is twofold. First, to secure a solid approval, and second, to find the most affordable rate among the available options. The range of APRs in their pre-qualified offers will likely be much wider and higher than for the good credit borrower. When it comes to expected loan terms, a borrower with fair credit should anticipate APRs that are noticeably higher. This higher rate is how lenders balance the increased risk they are taking on. The maximum loan amount offered may be lower, and origination fees are more likely to be a standard feature of the loan offer, often ranging from 5% to 10% of the loan amount. The underwriting process may also be more intensive. A lender might ask for additional documentation, or look more closely at the stability of the borrower's income and their debt-to-income ratio to ensure they have the capacity to repay the new loan. Let's quickly summarize the key differences. For APR, a good credit borrower can expect more competitive, lower rates, while a fair credit borrower will see higher rates. For fees, origination fees are less common or lower for good credit, and more common or higher for fair credit. For loan amount, a good credit borrower typically has access to higher borrowing limits. And for lender choice, a good credit borrower has a wider net to cast, while a fair credit borrower will focus on more specialized lenders. Despite these differences, the path forward shares the same fundamental principles for everyone. This is the most important point. Regardless of your starting credit score, the core strategies for success remain the same. Every borrower benefits from shopping around, from clearly understanding the APR, from reading the loan agreement carefully, and most importantly, from making every single payment on time. For a borrower with fair credit, a responsibly managed personal loan can be a powerful tool for building a stronger credit history over time, potentially opening up access to more favorable financial products in the future. In short, while your credit score determines your starting point, your responsible actions determine your direction. We've now seen how individual circumstances can shape the loan experience. But what about larger, external forces? In our next chapter, we will explore how the economy itself can influence personal loans. Thank you for joining us for Chapter 13. We'll see you in the next one. Hello and welcome back. In our last chapter, we saw how an individual's credit profile can shape their personal loan experience. But our financial lives are not just influenced by our own actions. They are also affected by larger, external forces. The health of the national economy plays a significant role in the world of lending. This is Chapter 14, Economic Trends in Your Personal Loan. How the bigger picture matters. Over the next 10 minutes, we're going to explore how major economic factors, like the policies of the Federal Reserve and the rate of inflation, can influence the personal loan market, affecting everything from interest rates to the availability of credit. This chapter is a general overview of economic principles for informational purposes only. It is not investment or financial advice. Our goal is to help you understand the context behind the lending environment you encounter as a consumer. Let's start with the most influential player in the U.S. economy, the Federal Reserve, often simply called the Federal. The Fed is the central bank of the United States, and one of its primary jobs is to manage the country's monetary policy to keep inflation in check and employment stable. The main tool the Fed uses is the federal funds rate. In simple terms, this is the interest rate at which commercial banks lend money to each other overnight. Think of it as the wholesale cost of money for banks. While you as a consumer never pay this rate directly, its movements create a ripple effect across the entire financial system. When the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money. To maintain their profitability, banks pass this increased cost on to their customers. This results in higher interest rates on all sorts of consumer products, including new credit cards, auto loans, mortgages, and of course new personal loans. Conversely, when the Fed lowers the federal funds rate to stimulate a sluggish economy, it becomes cheaper for banks to borrow. They pass these savings on in the form of lower interest rates for consumers, which encourages borrowing and spending. So, when you hear news about the Fed raising or lowering rates, you're hearing about a decision that will directly influence the APRs that lenders offer on new personal loans. This leads us to another major economic force: inflation. Inflation is the rate at which the general price of goods and services is rising, which means the purchasing power of a dollar is falling. The Fed often raises interest rates specifically to combat high inflation. For a borrower, high inflation has a few effects. As we just discussed, it's a key reason why the Fed might raise rates, making it more expensive to take out a new loan. However, for someone who already has a fixed-rate personal loan, high inflation has an interesting and subtle effect. It means you are repaying your loan with dollars that are worth less than the dollars you originally borrowed. Your payment amount stays the same, but the value of that money decreases, which can make the debt feel slightly less burdensome over time. From a lender's perspective, periods of high inflation and economic uncertainty can make them more cautious. They worry that as household budgets get squeezed by rising costs, the risk of borrowers being unable to make their loan payments increases. This can lead to what's called tighter lending standards. This brings us to the overall health of the economy, often measured by the unemployment rate and economic growth. In a strong economy, with low unemployment and confident consumers, lenders tend to feel more secure. They are more willing to lend, and the competition between them for good borrowers can lead to more attractive and competitive loan offers. However, during a weak economy or a recession, the opposite is true. When unemployment rises and people's financial futures seem uncertain, lenders become much more risk-averse. They worry about loan defaults increasing. As a result, they often tighten their lending standards significantly. This means they might require higher credit scores, lower debt-to-income ratios, and more proof of stable income. It can become more challenging to qualify for a loan during a recession, especially for borrowers who don't have a very strong credit profile. So, what does all this mean for you, the consumer? The key is awareness. Understanding these broad trends helps you make sense of the market. It explains why the loan rates you see advertised today might be very different from what they were a year or two ago. It also highlights a major benefit of most personal loans. They have a fixed rate. Once you lock in your loan, your interest rate and monthly payment will not change, no matter what the Fed does or how the economy fluctuates. This provides stability and predictability in an ever-changing economic environment. To summarize, the personal loan market is deeply connected to the health of the U.S. economy. The Federal Reserve's interest rate policies, the rate of inflation, and overall economic growth all work together to influence the cost and availability of credit for everyone. We have now covered the personal loan journey from your individual perspective, all the way up to the national economic one. In our final chapter, we will bring everything together into a conclusive checklist of key takeaways from this entire series. Thank you for joining us for Chapter 14. We look forward to seeing you for our final chapter. Hello, and welcome back for the final chapter of our comprehensive guide to understanding U.S. personal loans. Over the last 14 chapters, we have journeyed together through every stage of this process. We started with the absolute basics, explored the nuances of credit and underwriting, and even examined how the national economy can play a role. This is Chapter 15, Your Personal Loan Journey, a final checklist and key takeaways. In this concluding chapter, our goal is to bring all of this knowledge together. We will consolidate the most important lessons from our series into a series of simple, actionable checklists and 4 fundamental principles that you can carry with you. This chapter serves as a summary of the educational information we have presented. It is not financial advice, but a final tool to empower you on your financial journey. Let's begin with the first phase, the Before You Apply checklist. This is your foundation for success. First, understand your why. Have a clear and specific purpose for the loan. Knowing exactly what you need the money for and how much you need is the critical first step. Second, know your credit score. Check your credit score and review your credit report beforehand. This gives you a realistic expectation of the terms you might be offered and allows you to spot any errors that need correcting. Third, gather your documents. As we detailed in Chapter 3, have your proof of identity, proof of address, and proof of income, such as pay stubs and W-2s, organized and ready. Fourth, calculate your debt-to-income ratio. Understanding your DTI helps you see your financial situation from a lender's perspective. And fifth, review your budget. Before you even think about applying, make sure you have a clear picture of your monthly income and expenses, and confirm that a new loan payment can fit comfortably. Next, let's move to the shopping for your loan checklist. This is where you find the right deal for you. First, explore all lender types. As we discussed in Chapter 4, get a feel for the offers from traditional banks, local credit unions, and online lenders. Each has its own characteristics. Second, get multiple pre-qualifications. This is the single most important part of shopping. Use the power of soft credit inquiries to get at least 3 to 5 preliminary loan offers. This does not hurt your credit score. Third, compare by APR. Always use the annual percentage rate as your primary tool for comparing the total cost of each loan offer. It includes both interest and most fees. Fourth, look beyond the APR. Pay close attention to the details. Does the loan have an origination fee? What is the loan term, and how does it affect your total interest cost? Are there any prepayment penalties? Once you've chosen the best offer, you move to the finalizing your loan checklist. First, submit only one formal application. After comparing your pre-qualified offers, choose the single best one and complete that lender's official application. This will ensure you only receive one hard inquiry on your credit report. Second, read the final loan agreement carefully. This is the legally binding contract. Take the time to read through all the terms and conditions before you sign. And third, confirm all the numbers. Make sure the final APR, the loan amount, the origination fee, and the monthly payment listed in the agreement match the offer you accepted. Finally, once the loan is funded, you enter the most important and longest phase, the managing your loan checklist. First, set up on-time payments. The best way to build a positive credit history is to make every single payment on time. Enrolling in autopay is an excellent way to ensure this happens automatically. Second, communicate with your lender. If you ever face a financial hardship and worry you might miss a payment, contact your lender proactively. They may have options to help. And third, understand the long-term impact. Recognize that every on-time payment is a positive step. Successfully paying off a personal loan is an accomplishment that demonstrates your creditworthiness and can help you achieve your financial goals for years to come. As we conclude this series, we want to leave you with 4 final, overarching takeaways. If you remember nothing else, remember these principles. Number 1, knowledge is power. From understanding what APR means to knowing how underwriting works, the knowledge you've gained in this series is your greatest asset. It demystifies the process and puts you in control. Number 2, preparation is key. A successful loan experience begins long before you apply. Getting your financial house in order, gathering your documents, and knowing your numbers makes the entire journey smoother and more effective. Number 3, comparison is crucial. Never take the first offer you see. Shopping around using pre-qualification is the single most effective strategy for saving money and ensuring you get a competitive deal. And number 4, responsibility is everything. A loan is a serious commitment and a valuable tool. Using it wisely and managing your repayments responsibly is the ultimate key to leveraging debt as a stepping stone toward a healthier financial future. Thank you for joining us on this journey through all 15 chapters. We hope this series has provided you with the confidence and clarity you need to navigate the world of personal loans. We wish you the very best on your path to achieving your financial goals.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.